A little over a month ago, I did a video discussing what we'd want to see to determine whether the stock market is back in a bull market. And the basic criteria was that we'd want to see the major indexes back in stage two, breadth in the major indexes with 50% of stocks or more back in stage two, and leadership sectors breaking out of stage one bases. Now, what we've seen since that video is that the major indexes did move back into stage two, and breadth in some of the major indexes did move over 50%. In particular, the Dow Jones, the S&P 500, and the New York Stock Exchange all had considerable improving breadth as the rally from February continued to unfold. But the Nasdaq remained a laggard with, as we'll see in a moment, not even getting to 40% stocks back in stage two. And the third criteria, which really was lacking throughout most of the stock market, was leadership sectors breaking out of stage one bases. I was keeping my eyes peeled over the last few months for sectors that were starting to break out together into a new bull market, and individual stocks, trying to see, what stocks were trying to become potential new leaders if we were going to move back into a new bull market. And overall, the number of stocks breaking out was very minimal, and really, as far as sectors were concerned, besides the gold miners and some of the more defensive stocks and some of the commodity related stocks, there really wasn't any coherent new leadership sectors forming which could take the stock market higher. So, in my view, much of the rally from February was still all about mean reversion and short covering and probably stock buybacks and stuff like that, and not really the type of stuff you'd like to see for a new bull market to take shape. So, looking at the stage analysis screener, as of May 3rd, we can see that the Dow Jones, the S&P 500, and the New York Stock Exchange does have pretty good breadth, and but the Nasdaq, as I mentioned, is still a major laggard. And some other things that were concerning too is that foreign stocks, these developed foreign markets, have been lagging badly, which means that the United States is still really one of the sole markets that's actually in a uptrend as of February. So that's concerning because usually the global stock markets tend to move in unison. It's hard for the United States to buck the trend in the overall global markets. But one thing I want to focus on in this video is the underperformance in the Nasdaq. And one thing to note is that the Nasdaq is the largest, or technology stocks are the largest sector in the market. So they are extremely important, and if they're not in a bull market, the overall stock indexes are generally not going to be in a bull market. When you have bear markets in sectors that are smaller to the overall market, they can kind of operate independently of a bull move. But when you have the major sectors like information technology, financials, healthcare moving lower, it's hard for the overall market to move opposite to that. Now, one thing that's really kind of jumped out to me on the NASDAQ daily chart is that the number of distribution days since April is pretty extraordinary. If you look at the distribution day, is basically a day where the volume is higher than the previous day, and it's a down candle for the day. So starting from beginning of April, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 distribution days over that time period, which is one of the highest concentration of distribution days I've seen in a while. I don't look at these charts every day, but I can't remember seeing a cluster of distribution days like this, and actually the end of April is pretty interesting looking with 4 distribution days in a row, and also a gap down here that never filled. Um, so pretty bearish action in the Nasdaq on the short term. Now looking at the weekly chart, you can see the lower highs in the Nasdaq, and the Nasdaq is starting to um, move back below the 30-week moving average, which would indicate that a new definitely it's probably going to move back into stage 3 according to my screener very soon, and then if it keeps moving lower, it's going to move into stage 4. And notice how it filled this gap in the start of 2016 and then failed over the last 2 weeks, and that's kind of a indicator when the market can't overcome a previous gap but fills it. It's a good indication that this resistance level will hold, and a downtrend is taking shape here. And notice how the Nasdaq has been underperforming the S&P 500 since September of last year. You can see how it topped out here, and then it's actually gone below the moving average um, throughout 2016. So this downtrend against the S&P 500 is firmly in place. And that's a bad sign for the overall market because a lot of growth stocks come out of the Nasdaq, especially some of the small cap stocks that become larger cap growth leaders during a healthy bull market. Now, looking at the Nasdaq 100, it's notable that, of course, if you're familiar with the FANG stocks, a lot of the large cap stocks like Facebook, Amazon, Netflix, and Google were helping propel the market higher in 2015, and which caused the triple Qs to make a higher high in late 2015, unlike the Nasdaq overall, which made a lower high. So leadership started to center around only a few large cap Nasdaq stocks that were still moving higher, and that is actually pretty typical for a late bull market. And notice how the Qs did the same thing as the Nasdaq, where they filled the gap from the start of this year and then failed and turned lower. And again, notice how the large cap Nasdaq stocks are underperforming the S&P 500 as well. So the market can't even find leadership with these larger cap tech stocks, which is pretty bearish considering that most of the market is deployed in some of these major tech stocks. So with money fleeing these tech stocks, it really has not a lot of options to turn to for. Now, one last thing that I like to look at is the volume that comes into these inverse ETFs when the market goes into a correction mode. And notice that back in August during the stock market plunge, and then back early to start this year, there's a big increase in volume on the daily chart when the market started moving lower rapidly, and that's because market players are trying to hedge their positions and then get into these inverse ETFs to ride the typical surge you see higher during big down moves. And it's notable that there was a big increase in volume on the SDS a couple trading sessions ago, but you still haven't seen a really big uptick in volume quite yet. On the DOG ETF, which is the short Dow ETF, there was a increase in volume above average volume today. It's again not a big surge in volume quite yet to um, really show that they're going after the short side in an aggressive fashion. And again, the ultra short triple Q ETF hasn't quite seen an increase in volume yet either. So I'll be monitoring these ETFs to see if they're starting to attract more attention as the days move forward, because this weakness in the Nasdaq is pretty troubling for the health of the overall market. And it's interesting that it's coinciding with the typical sell in May um, phase in the market, where the summer months are typically slower months in the market, and the market could be vulnerable to another leg down, considering how weak the overall structure is.